Welcome to this edition of Diligence Inside America's Boardrooms. I'm TK Kerstetter and I'll be your host for today's show. We're going to be talking about closing the ESG gap, investors versus corporate directors. And joining me is Sarah Tomolonius, who's a board member with Quest Resource Holding Corporation, but also is the co-founder of the Sustainability Investment Leadership Council. So maybe we could just take 1 second and if you could just describe what the Sustainability Investment Leadership Council is.
Yeah, so it's an organization that works with multiple different stakeholders in the investment community to really understand, measure, and integrate corporate sustainability into business practices for a company's overall growth strategy.
A nonprofit, I assume?
Partially, yes.
Yeah.
Partially.
Okay. So you're a next-gen director, meaning that you joined your board when you were in your 30s, mm-hmm. Okay. Sort of, before we get into the sustainability question that I want to ask you, what was your experience? What did you find interesting or something maybe that you didn't expect when you actually got to join a public board in your 30s?
I was really struck by the fact that the people on my board, when I met with them during the interview process, were as warm, as open, as transparent about the company, and as receptive to different perspectives. I don't know that I thought I would be confronting a group that was sort of hesitant to bring in new opinions or opinions from someone who was 25 years younger with, frankly, 25 years less experience. But it's really remained true to this day that they have really welcomed diverse ideas for the betterment of the company. Now, the company that I'm on the public board of focuses on sustainability and sustainability solutions. So it makes sense that they would want a diversity of opinions because that's true to sort of the ethos of what the company does. But it was a welcome to me that I wasn't dealing with or butting up against people who are sort of saying, look, we want a younger director, we're welcoming a younger director, but we're not going to allow them the bandwidth to actually bring their opinions to the table and integrate those opinions.
So, in all the experiences that we've heard in the next gen board leaders, you had a very positive experience in the sense of joining a board and onboarding.
Yeah, I would say thinking about the board in thinking about companies and how there sometimes are conversations that are had in isolation. That's something that you deal with in the corporate level, and it's something that happens in boards too. So just making sure that you're part of all of those conversations, or as many conversations as you can be. And something that I did, I think as a next-gen board member, as any board member, you really have to ask. So I sit in on all of the committees. I'm on the Nominating and Governance Committee, but I sit in on audit and all of the others. And so I really get the full birth of the issues that the company is dealing with. And it makes me a better board member, I think. It educates me, and it really fundamentally allows me to understand intrinsically what's going on in the company, even if day to day there might be a conversation over here or a conversation over here.
Now let's take that and go back to our leadership council for a second. So in the perfect world, in your sustainability investment leadership council, what would you like to see, what are your goals? What would you like to see happen for sure when all is said and done?
For the confusion to go away. I think we were talking about this earlier, sustainability is a bit of a term of art, right? I mean, the best companies have been thinking about structural risk mitigation and long-term value creation for a very long time. And now we have investors asking for, ESG and talking about sustainability. And I think a lot of people, a lot of corporate executives, a lot of board members, lawyers, accountants are still figuring out what does this brave new world mean, right, and how do we address it. And so there's still major questions around measurement and around reporting. What we try to do with Silk is to get together all of these constituents, sort of those multidisciplinary constituents, get them together and really try to understand how to make our way through what sustainability means, so that investors and others really have something actionable to deal with. You say sustainability, okay, well, how do you benchmark it? And how do you really assess progress? And some of these things are, they're hard to wrap metrics around. Well,
there is absolutely no question that A, it's a good mission, but B, sustainability in this truest sense of the word has always been everybody's goal in the sense of creating long-term longevity for your company to be successful. Okay, if it was as simple as that, okay, there wouldn't be much. But when we start to get into the environmental or the social or the governance, when we get all those letters together and trying to define each of those and what's happening, my sense is we're losing the corporate director. We're losing their focus and their initiative in the sense of understanding, okay, what do you want me to do? True?
I think that's right. I think it's still difficult. I think you have these very big investors. You have the BlackRock, the State Street, the Vanguard, managing $14 trillion and controlling 25% of the vote on S&P 500 companies, and that's only increasing. So you have all of them with their stewardship teams coming to the table and saying, look, these are really important issues to us. Do something about it. And you have the board members going, okay, these very important investors with large votes are saying we should do something about it, and how do we figure it out? And then on the other hand, you have a real ambiguity where you'll have like CalPERS, for example, and Jason Perez saying, look, we need to focus on returns, put all those social issues to the side. And so there is this great wrestling about what's important. By the way, as you know, executives and board directors have to focus on the day-to-day of running the business. And they want to grow this business, and yet all of a sudden they have to, figure out how to report on ESG. I have to say, we still don't have the perfect report. We still don't have the perfect way to address all of these things, but we're getting better. So you have SASB, the Sustainability Accounting Standards Boards, that with their industry standards, and groups like GM or Nike and Kellogg's and JetBlue have been real trailblazers here and have really used some of this reporting and are starting to create a more integrated report. I don't know fully how to get us as board members from sort of, there to here, but I know that there are many ways in which, as you say, we're doing this already. So how do we just capture what we're doing already without creating too much of a mess so that we're spending all of these resources on doing some sort of reporting?
Yeah, so great point about the big three relative to their power, and especially State Street. If they start withholding director votes against companies that aren't meeting certain criteria, the good news is they haven't come up with that criteria yet, and that's
right.
One of the challenges. But PwC just finished their annual corporate director survey, and right now they're showing a very large gap between what investors feel is important in the ESG space and how directors value the importance of giving time to it. And that's not going to work, Sarah. You and I both know that the pressure of the investors, we need to close that gap somehow, okay? And you've addressed it, trying to make it simple enough that we can create standards that everybody can appreciate. But right now, even after the year that we've had, which has been focused on ESG a lot, we're still showing a pretty large gap between the corporate director and how investors feel.
There's a couple of things, I think. One, PwC in their 2018 census for next-gen board members, so board members under 50, only 6% of S&P 500 companies have board directors under 50. I think almost all of those, 95% of those, have active careers. So they're daily in the trenches of the risks and opportunities that are facing their boards as well. It's a wonder how you sort of bridge that gap. You also have these short-term pressures. So the majority of executives and board members say that they feel they have to show strong financial performance in under 2 years. But you marry that with the fact that the average tenure for board members is 8 years, and something like 15% have been on a board for more than 16 years. So really, I feel like when you have the pressure of the investment community saying ESG is important, board members who have been there for a very long time and really have not seen this kind of inexorable push to sustainability and ESG like has been going on in the recent sort of 5 years, there's going to be, and I don't want to predict a shakeout, but something's going to have to happen. I don't think you can have investors pushing like this and saying more and more, we're not exactly sure how to do it, but we want you to show us that this company is aligning with these ESG sort of ideas to grow, build and grow better companies. And then you have board members saying, not really sure how to do it. I don't have that answer. I mean, I wish part of forming Silk was really to try to figure out, let's put all these great minds together in the corporate, in the accounting, in the legal fields, and sit down and try to weigh what in the world is going on and how to make sense through it. I just know that the ostrich, with the head in the sand, that's not going to work. And it remains sort of self-evident that it's going to continue to not work. There's just so much academic research and studies that shows that high sustainability companies and companies with a long-term focus perform better in the stock market and by accounting performance measures over the long term. I mean, these are companies, McKinsey did a study in 2017 that showed that long-term focused companies had something like over a 20-year period, I think their revenue increased 50% or grew by 50%, and their performance, their bottom line by 80%. And then they added something like 12,000 jobs. So these are large large and mid-cap S&P companies. So there's a real financial imperative, financial materiality imperative for ESG.
Yeah. So we're out of time, but if I was back sitting on a public board today, I would tell my board, as we're figuring this out, to make sure they're communicating in their proxy and on their website and when they have opportunity that we understand, we want to figure this out, here are the steps that we're taking today, and let their investing public know that they're aware of the charge that's on their plate relative to this as all this gets sorted out, so that they are viewed as with the head in the sand, but they're viewed as somebody that's progressive.
That's exactly the right tack to take. I mean, the name of the game is and always has been communication. So effectively communicating, look, we're not exactly sure, well, I don't know if you have to say we're not exactly sure how to do this, but it's true. But we're aware of it, and it's something we're working on, and trying to pull from what they're currently doing to say, look, over here we're doing here's the E, here's the S, and here's the G. I think that it'll sort of take this great sort of what may seem like a storm of a problem to corporate board members and make it a lot more sort of practical and tangible and addressable.
Yeah. Well, Sarah, thanks for taking the time to come in and speak with us. I appreciate it.
Thank you.
And that will conclude this edition of Inside America's Boardrooms. We hope you enjoyed the show. We'll be back again next week when we take another look at a critical topic that'll help you be a better board member or committee member. So we'll see you then.